MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. It looks like we've had some gyrations since we last spoke 2 weeks ago in the stock markets.
And it seems that going Italian isn't the right way to go right now.
No, it's quite interesting to see what happened there this week, because the funny thing is about Italy and the euro and Italian bonds. These have been stories that people have been talking about and warning about, rightly so, for months, that we're heading for an Italian election. Italy has got a massive debt problem. It's got a debt of GDP of the highest among any of the countries in Europe except Greece, well over 100%. And now over the weekend, we had the Italian election, and the five-star party won, which is an anti-Euro party, and it looks like we're in some sort of form of political chaos. The prime minister said he's not going to form a government after that election, and I guess we're going to have new elections. But the important thing is that for a day, this caused the Dow to drop over 400 points. The Canadian markets took a hit. Gold went up. The bond market in the United States rallied dramatically. In fact, the odds of 4 rate hikes in the United States for this year collapsed. They were about 80% before yesterday, and now they're basically zero. So that's interesting. But the Italian thing's funny to me because the 10-year bond on Italian government debt was yielding below 2% at the beginning of this year, and yesterday it went up to over 3%. So that just shows you how dramatically something can change, even if the market itself barely seems to move and everyone is warning about these problems. And then no one cares. Then one day all of a sudden you see these gyrations in the debt market. And I think that's a warning sign for all of us that markets can shift suddenly, especially when it appears to be that nothing is taking place. And when it comes to a market like gold, which I know a lot of your listeners are in, I think back to 2007. In August of 2007, there was a very quick 10% drop in the U.S. stock market off the high of July that year. That was associated with the very first stories of debt problems with the mortgage markets becoming more apparent. And gold skyrocketed that month and broke out and outperformed the stock market for 12 months going forward from there. The U.S. dollar made a big move, and so did bonds. So I'm not saying that's about to happen at this moment, but I do think before this year is over, we're going to see sudden movements in the gold market in particular that is going to take a lot of people by surprise, much like the Italian bond market just suddenly moved, because gold has been going sideways now for almost 2 years, and everyone's kind of fallen asleep on it. It's trading in the range of basically 1360s high and 1280 now as support. And I'm not trying to predict the moment it's going to happen, but I remain positioned long because I do think that moment's going to happen where gold goes through 1360 and just takes off. And I prefer to be in it and be patient, and then instead of just watch it and then have to feel like I'm scrambling to get in something. So I think these are markets where you got to be careful. Sentiment, we've seen some changes in the stock market this year that will probably lead to something later.
It's really become the year of stay on your toes, and if you snooze, you really will lose.
Well, it depends on, it depends on what you're in too. The funny thing about the U.S. stock market is that, a few stocks, have done very well all year, which have helped lift up the averages or keep them up. For example, at the beginning of this month, I saw something very interesting. I follow lots of people on Twitter that are stock market traders and commentators and all over social media to try to get a gauge of the sentiment. And what I saw was everybody was taking note of a triangle pattern with the S&P and the Dow and the NASDAQ. They were connecting the highs of January and March, in April, to draw an upper trend line, and saying that when we broke that, it meant that we were going to begin a new rally, a powerful uptrend that will lead to new highs, and we would just be taking off and going crazy. It's sort of like what happened in a couple years past. 2011, something like that happened. In 2012, something like that happened. So people were expecting the same thing again. And instead, we did break the triangle, but the market only went up for a couple of days and really hasn't done anything the rest of the month. We had a down day like yesterday. Today's an up day. We had a couple other days like that. But in the overall context, nothing is really happening so far this month after that triangle breakout. And I kind of, my expectation is, well, first of all, I think that suggests that we're not in this powerful bull market anymore that people keep saying we're in, and I think we're in a topping market that will lead to eventually a new bear market, probably before the year is over. However, we've seen dips in February, in March, and just yesterday for that matter too, and the market isn't just collapsing or crashing, even with bad news, such as the Italy situation is bad news. The stock markets aren't crashing or anything like that. So when I say I think we're heading for a bear market, a lot of people listening will say, what are you talking about? We're not really falling. Whenever there's bad news, we come back up. And that is true. And I think we can debate whether we're in a bear market or bull market. For now, we're in a sideways market. Until that is resolved, it won't be, 100% clear to anyone exactly what's going on. However, the second point I want to make is that one of the things that has helped the stock market this year is the share corporate buybacks, and they're at a record level, on track for record level this quarter. So that's having a effect of holding the market averages up. And when that triangle breakout happened at the beginning of this month, it happened immediately after Apple announced a 100 billion share buyback program. That drove Apple stock to a new 52-week high, and Apple makes up over 12% of the NASDAQ 100. So just Apple itself going up helped to fuel that breakout move, and it's associated with the share buybacks. The problem with share buybacks is that they, there's about 3 months out of the year where they don't occur at all. And that creates an air pocket in the stock market. And those periods where they don't occur are the quiet periods heading into earnings. So when you have the earnings season come out, it typically starts with banks such as JP Morgan, Bank of America reporting. That period's going to be beginning in the middle of July. And in the 4 months preceding earnings periods, corporate CEOs aren't allowed to buy or sell stock. And they're in a quiet period where they're not supposed to talk to analysts or make a lot of public statements. And during that quiet period, the companies aren't allowed to buy back stock either. And interestingly enough, the last quiet period coincided with the March drop in the stock market. And it's really going to start again in the middle of June and in the middle of July. So I think we're probably set up to see a dip in the stock market back down to where we were in the lows of April and February going into the July earnings period. And not coincidentally, perhaps, the next Fed meeting is in the middle of June too, right before this quiet period starts. So I think we got like 2-3 weeks of okay times, with the stock market going sideways, maybe And in that situation, there will be stocks breaking out and doing good. Apple will probably continue to do good. Netflix will probably continue to do good. A handful of the big cap tech stocks. It's tough to trade them. They don't really have great patterns. You're competing with the robots. I'm more interested in sectors that are doing better. And right now, the best sector in the market, it's a highly speculative sector. It's the marijuana sector, the cannabis sector. Stocks such as Canopy Growth, weed, trading on the Toronto Stock Exchange. It's the biggest marijuana stock in terms of market cap. I think it can easily go through the $40 level. It's at 37 now. I don't own it, but I own a few others that don't really want to mention them necessarily on the show. They're small cap stocks, so I don't want to be like moving them or something. But the point is, there is opportunity there in that sector, and we're heading for this. It's kind of a buy the rumor, sell the news situation where we've got everyone trying to position themselves ahead of the day, whenever it is, in which Canada is going to legalize recreational marijuana use.
Mike, we'll talk more about that right after the break.
Okay, sure.
Okay, we'll be back right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome back. We're chatting with Mike Swanson. Mike, we still don't have a definitive date in Canada about when the federal government will make recreational marijuana legal. He promised sometime this summer. That gives him a pretty wide window. Does that hurt the speculation in it, or are people pretty confident that the feds will come through in Canada and legalize marijuana?
Actually, I think it helps because I would compare that to the situation last year with the Trump tax cuts, because at first, the news sort of was, oh, he's going to do this in March, April, May. It didn't happen. They tried to do healthcare first, and that turned into a fiasco, and then other things would happen, and they kept putting it off. And so it happened much later than anyone expected. But what that actually did was give the stock market bulls and speculators just an excuse to keep buying as time went on. And the funny thing is, the actual peak in the Dow and the S&P and the NASDAQ happened within days, actually a month after they passed the bill, and then passed the government budget just days after that. So actually, the longer they delay it, the kind of better it is, because I'm actually more fearful that when it does pass, a lot of people are going to simply start to take profits, because the reality is that these stocks got great momentum to them, but they are also extremely highly valued. I mean, they just are, and so I expect there'll be a lot of profit taking once the law does pass.
Could we look back at the end of Prohibition, when they brought back alcohol, and how stocks and alcohol companies behaved? When that happened, will the same thing happen with marijuana stocks?
Well, honestly, I don't really know what happened with stocks during the outlaw of Prohibition with beer companies and so forth. I really have no idea if they're even publicly traded. Do you know?
I have no idea. That's why I asked the question.
Yeah. I'll have to look it up and get back with you.
Now, what made Prohibition interesting in Canada was that liquor companies could continue to produce booze as long as it was for export. And of course, how much of that so-called export booze in Canada ended up in the domestic market, or you see, it was legal if we said it was going to the U.S., even though it was illegal to go to the U.S. But it was a foreign market, so yeah, you can make it. So how many, like the Bronfmans, that's when they made all their money.
Mm-hmm. Mm-hmm.
Or you always claimed, oh, we're shipping it to Britain. And somehow those boats didn't get any further than 12 miles down the coast.
Oh, wow.
Yeah, the stories.
Yeah, I actually doubt, I mean, I'd have to go look it up, but I doubt there were any pure, like, alcohol-traded companies back then, because it was really illegal. The marijuana thing, you know, it is legal for these companies to grow and build these facilities and so forth. Actually, another thing that's just happened in the United States is they have repealed these, the Supreme Court, I should put it this way, the Supreme Court ruled just the other week to allow states to legalize sports gambling. So that's something that, a lot of these casino stocks did pop for a couple of days on that news, but I don't really think a lot of people were betting into that one. So it kind of took a lot of people by surprise. The casino stocks themselves, for the most part, have been lagging the stock market since February. So that might be something that could be some opportunity for people to find the right stocks to play in that sector. With the casinos, I would suggest that Caesars is probably the best positioned national casino company to benefit, but I'm sure there'll be smaller players too.
We'll have more with Mike Swanson right after the break.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, do you expect oil prices to soften up? Because it sounds like OPEC and Russia are going to ease up the taps. They've been very good at keeping their reduction or their freeze promise, but it looks like they're eyeing, U.S. shale producers very jealously, and they want to get in on it.
Yeah, it's not quite as bad as it was, a couple years ago, and OPEC flat out said we want to lower the prices to destroy American shale production. They actually accomplished the fact the feat that they wanted to do when in 2014, American shale producers started to go under. A lot of them did. So they don't need to smash the whole market again like they did before. But it does appear that oil prices have probably reached some sort of plateau for now. Interestingly enough, a few months ago, I saw talk where Saudi Arabia was saying we want the oil price to get above 70. Well, they've achieved that. So they don't want the price to get too high, over 100 or whatever, because then it will incentivize the United States to start to put more money back into shale and alternative energy sources. So that I think they kind of want a sweet spot of oil above 60, but not too much, beyond the $80 range or 75 or something. So it does look like for now that's where we are. And in the oil stocks themselves, a lot of them did, have sold off recently over the past week. Although today they're all up sharply. So it'll be interesting to see how they trade out, because to me it looks like Exxon, all the major oil stock companies, the charts suggest that they're going to pause and go sideways for a week or a month, and then we might have to see from there. And they could even pop a little higher, even if oil just maintains this current level, because seasonally, the oil stocks and oil prices themselves, for that matter, tend to stay strong into July and then fade into the fall. So that probably is what we're set up for.
Yes, oil didn't go along with the seasonality over the past 6 months at all. Usually it dips in the winter. It didn't. And it kept climbing. And now we're into the so-called driving season, and the price of oil has dropped a bit. So it's not behaving in the way that it did in the past. Does that make it harder for people to trade?
Well, I still think it's likely to. Actually, I think it makes it almost more likely that it's going to dip after July. You know, pulling up a chart now, it is kind of interesting. It has basically been rallying since September, but that rally came after, you know, a decline in oil down to the $30 level, or $40 level, I mean, last year. So I think we've basically just seen a huge rally. It really picked up steam last November when we broke through 55, and this is actually the past couple of days is probably the biggest drop we've seen in oil in over a year, or at least since September. Yeah, it's probably due to go sideways here or for the next couple of months or trade weaker than we've seen.
Is it true that U.S. farmers are not growing grain this year but have decided to go to cotton?
Well, the agriculture market is interesting because the prices for cotton have been climbing this year. Prices for wheat have been stagnating, and stagnating after years of stagnation. We've had a bear market across the board for agriculture and soft commodities now since 2014. And if you compare agriculture prices to the U.S. dollar, the stock market, inflation, and on, it's basically the lowest it's ever been. I think there's eventually going to be a lot of opportunity in that to take long-term investment positions, but I'm cautious on doing that myself at the moment. I just think the overall sector is likely to go sideways, and one reason is the wheat situation. Farmers are starting to grow less wheat and move into cotton. However, when you see that type of news in a commodity, because the prices have fallen for years and they can't make any money, so we're going to stop growing, that's the sort of thing that you need to see to build in a bottom. And bottoms in commodities don't happen overnight. So I think, you know, that could be setting up a good bottoming phase for wheat. Probably, you know, I would be looking to buy it next year or towards November to this year, November to the first quarter next year. That's typically when these things bottom out too. Commodities as a whole, or agriculture commodities as a whole, tend to top out in June, July also, and fall into the first quarter unless there's some sort of drought situation or something very unusual. And as far as I know, there's no sign of that.
How is uranium doing right now?
Well, uranium is still fairly stagnant. You know, we had a huge bull market in uranium about 10 years ago, and then along with other commodities, uranium prices had a vicious bear market in 2014, 15, and 16. But if you look at the uranium stocks, they're basically going sideways now, much like the mining stocks, the gold and silver stocks. The uranium stocks have been going sideways for 2 years, except they're trading weaker than gold and silver stocks. And there's really only a few uranium stocks that even produce, Cameco, of course, being the leader. So when you look at the uranium industry, it's really a more company-specific story. But, you know, I don't think, you know, there's no signs that I don't think we're on a major trend change immediately when it comes to the price of uranium or these stocks, either. I would think that they're going to have to follow what happens with oil and other energy prices and gold and silver too, and sort of lag. So I think it's, you know, a year or two off before these things really go crazy, but it'll happen again one day. I just think we're still in this sort of, you can invest in it, don't expect to make, a giant return overnight, but if you got a long-term outlook, that's fine, and I wouldn't expect them to crash or anything like that. So, there's nothing wrong with taking long-term investment positions. I got a lot of long-term investment positions in various mining stocks.
Is there any sector right now that you wouldn't touch with a 25-foot pole?
Well, the worst things I think right now to invest in are bonds, actually, treasury bonds, corporate bonds, especially the corporate bonds. And the reason why is that we have seen the greatest bull market in them ever, starting in 1980, and then in 2016, we had, I think, the most extreme top in the global bond market in human history. That's when countries such as Germany were yielding negative interest rates, never before seen in the history of man. And if we link that to the Italy news, what happened was in 2016, there was a drop in the U.S. stock market. It fell 20% from the high of 2015. And there are drops going on all over the world and some stress in Italy and Greece. And the European Central Bank did a QE bond buying program, jammed down the yields for all these debts, enabled U.S. corporations to issue record low interest rates, use the bond market to issue junk bonds of record low interest rates. And that's really been a big backdrop to the past couple of years. It's helped fuel the corporate share buybacks, which have helped the stock market, which helped, Apple just issue $100 billion new buyback announcement. But the point of the key about this, though, is that if we saw a manic record valuation top in the bond market basically 2 years ago, that's bad from a long-term investment standpoint. And right now, treasury bonds in the U.S. are down year to date. TLT, for example, the ETF, is down for the year. Most corporate junk bond funds and ETFs are down for the year. Historically, Americans will put 50% or divide up their money in stocks and bonds like 50-50. And usually when there's a stock market, bear market, bonds go up because Fed lowers rates and from a high level and it helps the bonds go up. We're not going to be in that situation when the next bear market comes. Bonds are going to go down too in time. And that means they're a terrible investment. You don't get much interest return on them, and they can fall in value over the next couple of years. So I think that makes alternative investing, such as in gold, silver, other commodities, I think that's going to be the play to be in over the next 3 to 5 years. But as far as stock sectors go, which I would say bonds are the worst investment. The next worst, if we look at individual stock sectors, I would then probably say banks, because they've had a tremendous run since when Trump got elected, but they're interest rate sensitive to short-term interest rates, and we're in this interest rate hiking cycle. And just today or yesterday, the odds of the pace of the rate hikes just got slammed, and that hurts bank stocks, and bank stocks are basically down a little bit year to date in the United States after having a tremendous run before. So I think that's a sector that I would kind of avoid also.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guest can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.